Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Lauren Steinberg, CFA and co-president at Lauren Steinberg Wealth Management, is our guest co-host. In 30 minutes, we're going to be looking at oil amid global political issues with Jeremy McCrae, Managing Director in Energy Research at BMO Capital Markets. And of course, we want to hear from you this morning on First Call. You can reach out with your questions on global value stocks and fixed income, and we'll have Lauren answer as many of the questions as he can at the end of the show. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes, and of course you can email us at firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Canada has sealed a new trade deal with China. Prime Minister Mark Carney says Canadian tariffs on Chinese EVs have been eased in exchange for reduced levies on canola exports. The announcement coming after the Prime Minister met with Chinese President Xi Jinping, looking to reset strained trade relations.
Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market, with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians.
First Quantum Minerals says that the Panamanian government has authorized the processing of certain minerals at the Cobre Panama copper mine. The Toronto Mining Company is still waiting for official approval before the mine can be reopened. Panama took control of the mine in 2023. Bloomberg News is reporting French President Emmanuel Macron met with leaders of Paramount Skydance to discuss the company's hostile bid for Warner Brothers. The visit to France is said to be part of a larger European push for support from Paramount, with Chair David Ellison meeting in London with the Culture Secretary on Thursday. Now, despite Warner Brothers rejecting Paramount's offer in favor of Netflix, Paramount continues to seek a deal. And now, our top-line story. Prime Minister Mark Carney meeting with Chinese President Xi Jinping. To bring more context to this meeting, Bloomberg's Stephen Engel explains the significance.
We're showing you live pictures out of Beijing, where Chinese President Xi Jinping is meeting Canadian Prime Minister Mark Carney. Of course, Mark Carney is on a tightrope here, trying to mend ties with China while still trying to regain and restart trade conversations with the U.S. Carney on a mission, of course, to increase trade relations as he looks to double trade out of the U.S. markets in the next 10 years. Key to that conversation, of course, trade as well as security. We know that the Chinese have been calling it pretty much a victory, a political victory for Beijing. Let's get to our Chief North Asia correspondent, Stephen Engel. He joins us from Shanghai. Steve, how significant is this framework agreement on anti-trade? We know this has been signed, and of course, the two leaders are meeting right now.
I think it's quite significant, especially because Mark Carney has repeatedly talked about the historic rupture between Ottawa and Washington, between Canada and the United States, because of Trump's policies and those tariffs. Now in Beijing, when he met with Premier Li Qiang, he talked about this new partnership with China as being part of a new world order. Those are his words, and quite strong words to say that this is a new world order. And clearly, it's been a tone shift from Ottawa towards China, because the last 8 years have been quite difficult. A frosty diplomatic relationship between Canada and China. Back in 2018, of course, they had the arrest of Meng Wanzhou, the executive of Huawei, the daughter of the chairman of Huawei. That arrest at the behest of the United States. And then Justin Trudeau's policies on trade in 2024 essentially were put in line with the United States. So there were 100% tariffs on Chinese EVs. EVs to protect Chinese or Canadian automakers and auto parts makers. There was, of course, also further tariffs on other areas like steel and aluminum. China retaliated in that sense on agricultural products, putting tariffs on a key crop from Canada, rapeseed, which is also known as canola. So these are all areas that these two gentlemen sitting across the table from each other today can potentially ease those tensions, ease those tariffs, reciprocal tariffs, and put the relationship geopolitically on a new footing. But again, there will be resistance if, this energy framework agreement that the two sides agreed to yesterday and essentially inked, that is going to, possibly welcome more Chinese investment in the energy sector in Canada. You already have Chinese oil giants involved in the LNG Canada's project in British Columbia. They're invested in the oil sands in Alberta. But China clearly needs another diversified source of oil and energy because of what's happened in Venezuela. China was buying a lot of Venezuelan oil sanctioned by the U.S. They also buy 90% of Iranian oil, which is now in question, of course, because of Trump's intentions possibly there. So there's a lot at stake, to put it mildly.
Okay, so China and Canada have reached an agreement to lower trade barriers and rebuild ties. Let's bring in our guest co-host, Lauren Steinberg, CFA and co-president at Lauren Steinberg Wealth Management, for more on this developing story. A lot of people, we were talking about this before the meeting started. First of all, good morning, and thank you for joining us, Lauren.
Thanks for having me.
I was getting right into this because it's been a crazy couple of weeks. Before these meetings with China, we thought maybe they'll kind of reconnect, swap numbers, and say, let's talk a little more. But all of a sudden, they come out with canola and EV deals.
I think Carney's caught between a rock and a hard place. He needs to cut a deal with China and not be under the foot of the U.S. with everything. I think this is probably a pretty good deal. We're allowing very few EVs to come in, and it's a great deal for canola farmers that have been under tremendous pressure. I think Carney's done a reasonably good job here, but there was really no option.
Mm-hmm. Now, I mean, there's still a tariff on the canola, but it's one they can work with, right? 15%, I think, is what it drops down to.
It's down to a more normalized level.
And did we give up the farm, so to speak, for anything here? Does it feel like? Or
I don't think so.
That was my concern, because it doesn't feel like we're necessarily negotiating from a position of power.
We're not
anywhere.
Exactly. And so, allowing a small number of EVs is not going to make the Canadian auto sector happy at all. It's not going to make Ford happy at all. But I think it's a pretty small thing to trade to just get back on having good relations with China and leveraging that relationship, hopefully a little bit with the U.S. to show that we have options, and also showing Canadian industry that we're going to stand up for Canadians and for jobs as well, which is critical, and not just give everything away. We can't afford to play hardball with anybody.
And how do you think Canadians are going to react to these EVs? Will they look at them and purchase them if they're available?
There is such a small number that will be allowed to come in that I suspect there's enough of the population that will buy them. They're coming in at very, very cheap prices. They'll be way cheaper. In fact, it's the lower priced EVs that'll be the beneficiaries, so the $35,000 EV. And so I suspect they'll probably fly off the shelves.
Yeah, and as they lower they're kind of lowering the tariffs as we go to a degree. With some of them will be down. I thought I saw 25,000.
Exactly. So like I said, I think they'll fly off the shelves. There's so few of them coming in that there will be enough Canadians that won't care, make a judgment.
Elbows up or not, it won't matter.
Exactly.
And with the canola, is a lot of this what we're seeing with this deal? Is it a bit of symbolism, really? Because there wasn't really much movement happening with the EVs. And the canola, I mean, China, I think, needs the canola. And so everything we've got it down to a place that we kind of were before all.
First of all, of course, there's a lot of symbolism, especially with China. But it does seem to reset the relationship. And for China, the face saving and everything else is a huge issue. And they want Canada to look at them as unlike the U.S., not as an enemy, as a friend. And so that's a huge part of this, but I think Canada basically needs it because we don't have much choice.
Does this open up a path for oil going that way as well?
I think it opens up a path for energy investment, which we could probably use. Oil prices are depressed, and I don't think this deal is going to change very much that way in terms of how we're getting oil over there. I don't think it's going to have a huge impact in the near term on anything to do with Canadian energy prices.
All right, and now the elephant in the room. He has not gone on Truth Social yet. Donald Trump has not responded yet, which kind of surprises me. I thought we might have heard something from him already.
And I think it just hasn't possibly happened yet. That
Nobody wanted to wake him?
We're all waiting. We're all waiting for the other shoe to drop. But the U.S. cannot be happy at all with the deal and with the press conference.
Okay, and what kind of an impact, quickly before we go to break, what kind of an impact do you see this having on the CUSMA negotiations?
I don't think it's going to have any significant impact because that's still a few months away. And I'll tell you the best thing in Canada's favor with that is that the U.S. auto sector and many other manufacturers are aggressively lobbying U.S. policymakers to keep the U.S. the CUSMA because they're the ones who are going to get hurt. It's going to kill the U.S. auto sector. It's going to cost them tens of billions of dollars if they had to actually make cars there. Cars were expensive, so I don't think it's going to have a big impact.
Okay.
But there'll be a lot of noise.
All right, well, we'll leave it at there. There's going to be lots more on this. But coming up, we'll take a look at the markets before the bell. See how things are shaping up on the markets right now. We'll start with the U.S. futures and earnings and AI again driving the market. You can see the NASDAQ looking up right now. Same with the S&P 500, and the Dow is awash at this point. Over in Asia, a weaker yen and some profit taking pulling down the Nikkei in Japan off by 0.32. Chinese market soft on caution around China's growth outlook. Hang Seng off by 0.29. CSI 300 off by 0.4. Off to Europe, profit taking there and a retreating gold and silver, putting downward pressure on, I should say. You can see FTSE off just slightly, still above 10,000. CAC Caron off by 0.7, and the DAX down by 0.28. Now the TSX still going gangbusters. Strong showings in financials, industrials, and some materials, leading to a record high close above 33,000. It's up 4% roughly for 2026. Some of the winners and losers yesterday. Let's take a look. Bombardier up 7.1% on that announcement of a new expansion in Montreal. Finning up 5.4. High gold and silver 5.5. It was down, and Alamos Gold off by 6.2. Taking a look at the metals, pullbacks there across all three, but still they are well up over last month and over the year. Gold's off by 0.48%, but still above 4,600. Silver dipping below 90. It's not a conversation we had a month ago. It's down 3.6%. And copper is off by 2.5 at 584. And looking at oil, geopolitical concerns like Iran are easing, and that is putting downward pressure on oil. You can see WCS yesterday off by 5.6%. And what is WTI doing now? It's bouncing back a little bit. It's up 1.12. It was off slightly earlier. Okay, our guest host is Lauren Steinberg, CFA and co-president at Lawrence Steinberg Wealth Management. And we talked about cars, EVs. Now let's talk about, well, not really, they're diesel trains, I guess, but trains. Maybe we'll get to planes later and do the movie again.
Exactly. So, the rail sector in Canada has really massively underperformed over the last few years. And this is a great opportunity for investors to step in, regardless of whether we get a good new trade agreement with the U.S. or not. And that's put a lot of downward pressure on these stocks. Sure, steel and aluminum shipments are down because of tariffs. Both of these companies, Roger, are perfectly prepped to deliver double-digit earnings growth over the next few years. So CP Kansas City, they merged a couple of years ago, but the reality is the integration is continuing. There's still plenty of cost cutting to be done there. And they're going to be the fastest growing rail in North America, fastest growing rail company. And CN has downsized it cut costs, and it is also prepped for double-digit earnings growth. And investors have an opportunity here to take advantage of weak share prices in a market that is not cheap.
It sounds like they kind of used that time. It was off, but they used that time to get things right.
Absolutely, and I mean,
which isn't a bad thing.
And decisions take a long time to get implemented in these industries, but efficiencies are way up, and rail remains the cheapest mode of transportation for so many goods that even stuff going to the States without a trade agreement, there's no option. You have to use rail, and these are long-term growers. They should grow faster than the economy, and when do you buy them? You buy them when they're down.
And it is the classic, they're not building more rail, right?
That's for sure. For environmental reasons, there is zero rail being built. They're all cutting agreements with various different competitors to get more efficient and invest. This is the time.
And with everybody's talking about tech and AI, are they benefiting at all from any of that? Is there?
I tell people AI is real, and every huge major company is looking at ways to use AI, and for sure from an efficiency standpoint, predicting how many cars do we need on this at different times during the year, weather patterns, all kinds of things. It will certainly make them more efficient.
Mm-hmm. And so that's something from one of the aspects of it. Now, what about headwinds? If CUSMA, we've heard Trump say he's going to tear CUSMA up, we don't need it. What kind of an impact would that have on rail? Would products still move?
There's no option. Like I said, for a number of goods, rail remains the cheapest mode of transportation. So for us, these stocks are already positioned as if CUSMA is not going to get approved. I have to say our own view is there's so much lobbying going on from the U.S. auto sector and others to have a trade agreement. We're pretty convinced there'll be some sort of trade agreement, even if it's not as good as the previous one.
What other concerns are there or possible headwinds?
One of the biggest headwinds is always weather, because weather can slow down rail, and then that costs these companies money, and so that's just part of the cost of doing business. But from a competitive standpoint, nothing much else. There's a big merger that looks like it's going to happen in the States. And CP Kansas City is already lobbying themselves to go through every line of that agreement to make sure that from an antitrust standpoint, certain divisions are sold and that kind of thing. And so, from a competitive standpoint, marginal for CP Kansas City, but that won't affect CN at all.
And just going back to the weather for a sec, are they factoring in, are they building for more extreme weather? I mean, that seems with climate change and the concern with that.
The rail's already built, and this rail lasts for such a long time. It's not like you can change it in 7 years. Yeah. So there's not a lot you can do with existing structures, and certainly anything new will be better able to handle things, but that is more long term. If we get bad weather, it's going to impact these companies, and they can't do much about it.
Yeah, and with the mergers, M&As, are we going to see more, or is that?
Well, there's not a lot to happen.
There isn't really much to move, is there? Right?
At the macro level, there are small railways, which is not going to impact either of these companies, but it's not going to have a huge impact. But anytime your competitor becomes more efficient, it has some impact on you.
Okay, and what could be a surprise, like a positive? I'm fighting a cold, I think, today. What do you think could be a positive surprise?
If we get a trade agreement that is anything reasonable, that will be a huge positive event. Okay, for us, it won't be really that much of a surprise, but it'll be a huge positive event. And probably coupled with that would be a reduction in tariffs on steel and aluminum. That would also be a huge positive event. So we don't see any negative events that can really impact things, but we only see positives.
Okay, we'll leave it on that note there. Leave it on a positive. We're taking a break, so grab a coffee. We'll be back with Lawrence Steinberg to see why Starbucks is on his radar. You see where we went there, right? Time to see what's on the radar for Lawrence Steinberg, the CFA and co-president at Lawrence Steinberg Wealth Management. Now, of course, morning coffee. We're going to talk about Starbucks first. We were talking about Constellation's coming up, but that's the stock everybody seems to love to hate right now. But let's talk about Starbucks. A little coffee in the morning, get everybody going. What are you liking about it right now?
What we're really liking about Starbucks is they're now 15 months into their turnaround. You don't turn around these companies overnight. We think they're on absolutely the right track, that earnings bottomed out in 2025. We're looking for a big bump in earnings in 2026 and margins returning back to where they were by 2027. We first saw the early signs last quarter of a little tick up in same-store sales for the first time. They've offloaded their China business,
I was
which
gonna
was
say,
a big pain point, into a joint venture where, well, they're own a chunk of it, but they're no longer running it, and they can focus themselves on the markets that are where they really see growth. The new CEO has done a good job. I happen to have checked out these stores on a regular basis, and you notice the change.
Research, purely.
Exactly. You notice the change immediately. They've added an assistant manager to every store. The staff is friendlier. I've spoken to staff members. This company is poised to get back to where it was.
Is that a big expense to add an assistant manager?
It is an expense, and so their expenses per store have gone up. Starbucks has huge margins. Wouldn't be surprised to see some price increases as well, because the customer base is fairly price resistant. The person that wants their $7 pumpkin spice
get their
latte,
$7 pumpkin
if
spice
they
latte.
spend an extra 40 cents, they will. So we think they'll be able to offset that over the next couple of years, and which will drive margins up. But the key is same-store sales, and we do see that continuing to improve this year.
And now with China, they moved out of China, it was about 2-3 months ago, I believe, right?
Right.
Not
So
moved out, but,
exactly. They've cut their joint venture. They've got a good joint venture partner, and they can put their focus back to areas where they can make a huge difference.
and China feels like a market that you really want to have somebody on the inside.
They tried it on their own for a number of years. It worked well for a number of years. The problem is other competitors in China moved in with much cheaper products,
Yep.
and that finally just put too much pressure on the whole system.
So where are they focusing their growth then?
They're focusing, first of all, North America will always be a huge growth engine. Europe, listen, I've been to Starbucks everywhere in the world. It's incredible. I always say, not only is it the same coffee that is served to you, but it's served by the same happy university student. And they've done a fantastic job. They offer better benefits than every other fast food place. They keep their people, and the cost, of hiring is lower at Starbucks because people stay longer.
Oh, okay. Let's move on. Let's get to Constellation. It's the stock that seems everybody wants to hate on right now, but yet they're good.
Constellation Software is one of the best, if not the best, performing Canadian stocks over the last 20 years. Just way outperformed the S&P 500 and the TSX, and suddenly off by 40%. It's a software company, but unlike the companies we think about, this company has made 800 acquisitions over the last 20 years. They buy all kinds of small niche little companies with $5 to $10 million of sales, and don't really integrate them. They let them run on their own. So like a Microsoft will have no interest in these acquisitions. They run them more efficiently. What's happened is, people are afraid that AI is going to eat into some of their businesses, that organic growth is slowing, and the CEO that built this thing had to retire for health reasons. That being said, the existing team remains there. The focus remains on acquisitions in a very fragmented industry. And so this is something we're looking at.
Is it possible they're running out of things to buy?
We thought of that. And it's possible. It's part of our research is looking at, the fragmentation of this industry. Is it as fragmented as it used to be? Or has too much consolidation gone on and there are fewer opportunities? Because for this company, if there aren't acquisitions to make, the stock is worth less than it's trading for.
And then with AI, have you looked at what kind of are they incorporating it? Can they incorporate it? Does it seem like they'll be able to?
Everybody will incorporate it to some degree. The issue is, will it drive prices down for software, and will a lot of the users be able to integrate AI and not need as much of this software, or be able to use more off-the-shelf software, which will knock out a lot of these niche businesses? Okay. But we think we're a long way from that.
Okay, we're almost out of time, but you can do one line on why you like Disney.
We like Disney because streaming has returned to finally become profitable, free cash flow positive, double-digit earnings growth.
All right, we'll leave it there, Lauren. Still ahead, we're looking at oil amid global political issues, and our phone lines will open up soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email at firstcall@bellmedia.ca. Nicely done. Canada has sealed a new trade deal with China. Prime Minister Mark Carney says Canadian tariffs on Chinese EVs have been eased in exchange for reduced levies on canola exports. The announcement came after the Prime Minister met with Chinese President Xi Jinping, looking to reset trade relations.
Canada has agreed to allow up to 49,000 Chinese electric vehicles into the Canadian market. with the most favored nation tariff rate of 6.1%. This is a return to the levels that existed prior to recent trade frictions. But it's a return under an agreement that promises much more for Canadians.
First Quantum Minerals says the Panamanian government has authorized the processing of certain minerals of the Cobre Panama copper mine. The Toronto Mining Company is still waiting for official approval before the mine can be reopened. Panama took control of the mine back in 2023. Bloomberg News is reporting French President Emmanuel Macron met with the leaders of Paramount Skydance to discuss the company's hostile bid for Warner Brothers. The visit to France is said to be part of a larger European push for support from Paramount, with Chair David Ellison meeting in London with the Culture Secretary on Thursday. And despite Warner Brothers rejecting Paramount's offer in favor of Netflix, Paramount continues to seek a deal. And a quick look at the markets. Everybody in the green right now, south of the border. The Dow up ever so slightly, almost a wash, really. NASDAQ up by about a half point, and the S&P 500 up by 0.17. Despite a national decline in home sales in 2025, experts are forecasting a slight rebound for 26, thanks to first-time home buyers. CTV's Abigail Beeman has more.
My father talked about his first house that he bought was $80,000, which is now my down payment.
John Gilmer is like so many millennials struggling to buy a first home.
Feels almost like spinning tires.
Even with a household income above $200,000 a year.
The target keeps getting raised as fast as our savings.
Water building up behind a dam.
The Canadian Real Estate Association says pent-up demand from first-time buyers like Gilmer and lower interest rates fuel its new growth projections. After a 1.9% drop in 2025, CREA projects national home sales will climb 5.1% in 2026 and 3.5% in 2027. Prices predicted to climb, too, to a national average just under $700,000 this year and $715,000 next year.
People in their 30s who are saying, I need something big enough to start a family in, it doesn't exist. Or it exists in the legacy detached space, which is very expensive.
The so-called missing middle of affordable options.
People aren't necessarily interested in like a condominium townhouse or a condo itself, and they're having trouble getting into like a freehold.
CREA says over the last 2 decades, there's been a switch from building low-density detached housing to building mostly apartments. John Gilmer is hopeful this will be his year to buy, thanks to savings, lower interest rates, and financial help from his parents.
My $2,700 a month that I'm paying in rent could be used in much better manner where I'm building equity.
The Prime Minister has committed to doubling the rate of home construction. CREA says it has a sense of optimism about the federal Build Canada Homes Agency, but in the medium to long term. Meanwhile, the problem of affordable housing remains pressing today.
That's CTV's Abigail Beeman. Well, oil edged higher today after a volatile week. Brent trading above $64 a barrel after plunging more than 4% yesterday. Continued protests in Iran have led to disruptions in oil production and shipping, contributing to the drop in prices. Lauren, I want to bring you back in here and talk a little bit. Where do you see? We were talking about it off air. I want to get this. It's insane. Like for the first 2 weeks of the year, we've had an invasion, essentially an invasion of Venezuela where they seized the president, and threats with a war with Iran, and then
and seizing tankers.
Yeah, and nothing's happened.
I think people,
not a full invasion. I shouldn't say that, but they did go in and seize the president.
I think one thing for sure, no matter what the U.S. administration says anymore, people are just so used to all kinds of things coming out of there. They don't take a lot of it seriously. Second of all, the oil market fundamentals are not good. There is an oversupply of oil, and there is minimal uptick in demand. So, oil prices have been very weak for quite a while, and we would expect that to remain the case. These, geopolitical issues can always have a huge impact, but at the present time, it doesn't look like the U.S. is going to go into Iran, and if they did, that would cause an uptick. But the fundamentals are not great. And, you hate to make investments, based on some geopolitical event that may or may not happen.
With just talking about the surplus, I mean, that's been running for a while too.
Exactly.
Like how much longer can it keep running?
So we're still, when we look at the pure data,
Yeah.
we are still looking at oversupply. And also, the Trump administration has been very close to Saudi Arabia, and Saudi Arabia does not want to upset Trump. And with the midterms coming up, does not want to cut back on production, even though it's putting pressure on prices.
All right, we're going to bring in Jeremy McCrae. He's the Managing Director in Energy Research at BMO Capital Markets. Jeremy, thanks very much for joining us. We were having some technical issues, but we've got those resolved, so I'm glad we can bring you into the conversation.
Great, thanks for having me.
Let's get your thoughts on where we stand right now with oil.
I tell you, what a week to start the year. We got from one geopolitical event to another here, from Venezuela to Iran. As you head into the weekend here, there's other concerns of what goes on the weekend. And it's a lot of just concern and nervousness out there right now with the market.
Okay, what concerns do you have for this weekend?
So Iran never really looked like it solves the full issue here. I think the immediate reaction was what could potentially happen. There's not really a lot of precedent here in terms of how big things could be. But if you look back to 2020, that's when sanctions brought off about 1.9 million barrels of oil. So I think that's what a lot of the oil traders were thinking about is, do we get to that type of scenario? What is the possible ramifications of what could potentially happen here on the weekend?
Jeremy, let me ask you a question. When you look at the actual fundamentals of supply and demand in the oil market, what do you see?
So you got disagreeing opinions here with a few of the bigger organizations, and not so much it's how investors perceive these different perceptions. So you have the EIA, who just came out with their forecast here, and you're still growing at 1.2% into 2027. But the amount of OPEC production that is looking to come on really pushes onshore inventories to levels not seen since effectively COVID. But then when you look at the OPEC is expectations for demand here for 2026 and 2027, it's quite a bit above EIA. And so that's why OPEC is producing as much as they are, saying we need to keep a balanced market to match the demand that we're expecting here. And so this is where you get these fundamental differences in opinion, and why there's a lot of unease in terms of what we actually could see for the oil markets here for 2026 and 2027, just given such big differences in expectations.
And what are your thoughts on those two? Which one is there one or the other you're leaning toward?
I tell you, so if you look back at history, the EIA tends to be middle of the road. OPEC tends to be a little bit more optimistic, and the IEA tends to be pretty bearish, and that's generally what we see. And we ultimately, halfway through the year, things start to coalesce into a single number here. But this is probably one of the wider ranges we've seen in terms of the forecast between the two, and I think that's what's causing a lot of the concern here with investors that we talk to is who is right, who is going to be adjusting. And I think what it comes down to is investors are saying, well, if the demand isn't that high, OPEC likely does cut, and that does likely put a bottom here. When you look at how economic a lot of the new plays and new drilling is at these levels here, it really is starting to get to that real marginal level. And so I think you are ultimately we're going to see some production declines coming from non-OPEC countries here, which ultimately should put a support into where we are seeing with oil prices here today. But that said, when does that happen is a little bit more concerning, especially when you add in all these geopolitical events for investors.
And when you look at the sector in general, can you talk about valuations and what you like?
So when you look at the commodity price here today, relative to valuations, it's higher than what we've seen before. But when you look at other sectors, though, energy is still seen as reasonable, relative to everything else. And so that's why you're seeing some more inbounds in terms of, maybe we got to look at energy here, and we haven't been involved in energy for a while. We are seeing more investors look at natural gas type of names here versus oil, not wanting to play a lot of the volatility. But what we've always told clients in this type of market, it's best to just stay safe here. So you look at royalty names. So Topaz and Prairie Sky would be two names we would highlight, but then also names that have a cash balance that are also in top tier play. So this is where the Clearwater operators look. Headwater is one of the pure play companies in there with a cash balance. So these are, some of the few names that we would highlight here with investors who are looking for a way to play the bridge into higher oil prices without taking on a lot of excess risk where the commodity prices today.
And are we starting to get a better feel for what's the impact of Venezuela with Canada? And I guess this deal with China today, does that play into where oil might end up going from Alberta?
It's funny, like every day there's a new headline here that makes investors bullish or concerned here. And so I think there's a lot of information coming out of Venezuela, and everyone's suddenly trying to become an expert here, saying, how realistic can we increase Venezuelan oil? And I don't think the reality is anybody really knows. It does sound like there's probably a couple 100,000 barrels that could come on much more quicker, and that's what's leading to the heavy oil differential widening a couple dollars here over the last week. But it's hard to see how much. It's not so much the near term. It's the expectation for growth coming out of Canada. What's the growth coming out of Venezuela? And these are knowns but unknown in terms of how quickly can this all come out. And that's what's causing some apprehension just with investors here in terms of when do we get involved and how big could this really be here in terms of the blowout that we could see for heavy oil. I don't think it's going to be as nearly as dire as everyone likely thinks. But, this is talking about a year, 2 years from now. And I'm echoing some of the words that Exxon had, just a few days ago here last week.
Okay, Jeremy, thank you very much for joining us. We appreciate it.
Thank you.
Jeremy McCrae is Managing Director in Energy Research at BMO Capital Markets. Still ahead, today's market drivers with Bloomberg's Monique Molima. And our phone lines are open. Lawrence Steinberg, CFA, and co-president at Lawrence Steinberg Wealth Management is taking your questions. Call us at 1-855-326-6266. You can email firstcall@bellmedia.ca. And it's time to look at some early market movers. We're joined by Bloomberg Equities reporter Monique Molima. Monique, thanks as always for joining us.
Thanks for having me.
Okay, let's talk gas. ConocoPhillips, what's happening there?
Yeah, so ConocoPhillips, their shares are down in pre-market trading after Bank of America downgraded the stock. Conoco, like some of the other major oil producers, has been seeing a rise in shares recently off of some of the geopolitical tensions in Iran and Venezuela. But analysts are saying that that bump in shares is not expected to be sustainable. They note that the U.S. government is really intent on bringing gas prices down and now has more ability to do that with them taking over Venezuelan oil, which could bring more oils to market. And with gas prices coming down, that would also hurt the margins for some of the oil producers like Conoco. They also note that Conoco's cash flow is at a lower level compared to some of its peers and would need a higher price for crude to break even. So they just see some near-term risks for the stock.
Okay, let's move on. And we're not raising a glass to Molson Coors right now, are we?
No. So Molson Coors, they were downgraded at BNP Paribas today, and that weighed on their shares in pre-market trading this morning. They see a number of headwinds impacting the alcohol sector. Young people are drinking less alcohol than previous generations, and they're seeing some pullback in their market share in the U.S., and they see lower consumer sentiment, which is all weighing on the sector as a whole. And they say that this is going to impact Molson's earnings going forward in the near term. They do have a new CEO, which analysts are saying could help to turn things around, move more away from beer, which is having the most weakness right now. But they say this turnaround and these strategic shifts are going to take time. And in the meantime, that's going to weigh on their shares.
All right. And I noticed they upgraded PepsiCo to outperform from neutral because people are not drinking beer. They're drinking pop and stuff like that. Okay. GE Vernova is the last one we're looking at here.
Yes, so GE Vernova, their shares are rising in pre-market trading. The Trump administration and some northeastern U.S. states are going to be announcing an energy auction that's effectively going to require technology companies to pay for the electricity that they're using. There's been a lot of concerns recently around power affordability related to data centers and that raising some citizens' energy rates. And so there's been a lot of pressure for these companies to have to pay for these increases. And that's what we're going to see happening with this announcement that's expected later this morning. And as analysts at Jefferies say, GE Vernova is expected to be one of the biggest beneficiaries of these changes. They say that the companies that are working in transmission and distribution, like GE Vernova, are going to see more benefit than some of the independent power producers like Constellation Energy or Talon Energy. So that's why we're really seeing a boost in those shares this morning.
All right, we'll leave it there. Monique, have yourself a great weekend.
Thanks, you too.
Bloomberg's Monique Malima. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets in the pharmaceutical industry. Let's take a look at some of the notable analyst calls and recommendations for this Friday. Roche was upgraded to neutral, from Sell at Goldman Sachs, which cites the Swiss drug maker's improved growth outlook following positive late-stage trial results for its experimental breast cancer and multiple sclerosis medicines in late 2025. Analyst James Quigley says the trial results have substantially improved the outlook through 2030. Price target was lifted to CHF 365 from 260, with shares trading slightly higher in Zurich. Now, Sanofi was downgraded to neutral from buy at UBS, which cites recent disappointing trial data for the drug maker's experimental multiple sclerosis treatment, as well as the negative impact from the new U.S. pediatric vaccination schedules. Analyst Matthew Weston writes, quote, "The failures to address pipeline replacement power is too great a strategic risk." The price target decreased to 88 euros from 105. And when we come back, Lauren Steinberg, co-president at Lauren Steinberg Wealth Management, takes your questions on First Call. Well, time for First Call and first email for this Friday, and it's from Yasmin. Good morning, Roger and Lauren. Your thoughts on Oracle, please. Thanks so much.
Oracle's chart looks like a spike went up and a spike went down. They're spending a ton of money. They're being very, very aggressive on the AI front. We think there are better places to be, quite frankly, in the software space. We prefer companies like Microsoft, Alphabet, and Meta. Oracle's more of a crapshoot and not really crazy about the strategy. I just think there's too much risk to this company, and earnings could really head south, and cash flow could head south, and with a strap on some debt. So we think there are better places to be.
What's the biggest concern about the risk?
Biggest concern about the risk is they're spending all of this money, and we're not sure they're going to get an adequate return. In fact, we're somewhat bearish on that. And it's going to impact the valuation of this company, and also taking on some debt. Not crazy about that either. They're making a very big bet here.
Okay, let's leave it at that and get to another email. This one from Tony. I would like Lauren's take on TELUS for 2026.
So we like TELUS. I mean, TELUS has been paying out too much in dividends. They're going to slow the dividend growth going forward, and reinvest the money, pay down some debt. But actually, we like telcos in general. Finally, after years of zero growth and margin compression and competition, we're looking for prices to move up slightly. Not great for Canadian consumers, but all of these companies have cut costs aggressively and are poised to start showing some growth again. So we own TELUS, we like TELUS, and think there's a good opportunity for double-digit returns if you combine the dividend as well.
Where do you see the growth coming from?
We see the growth coming from actually price improvement, some growth in new subscribers, and because of the cost cutting, we think that will generate enough revenue and earnings growth to get to your double-digit return over the next few years. dividend being a good chunk of that, of course.
And then do you see the dividend coming back up?
We see the dividend rising very, very slowly, much more slowly than it has been, but we're happy about that because all these companies had too much debt and they need to get a little more careful about using cash flow to pay down debt and invest a little bit in growth.
Okay, and we're going to get one more email in, this one from Len and Mike. Lauren, love the most recent performance of Allied Properties. What is your outlook for this stock as back to office seems to be picking up momentum? It definitely is.
So back to office is reality, interestingly enough, for the tech companies as well, which everybody used to work from home in. And so there's still a bit of an overhang in office space in Canada, there's no question. And that's not going to go away anytime soon. Back to office means, 2 to 3 days a week for most companies. We think the stock has bottomed out and will probably be okay. We don't own it at the present time, but it is something we're actually looking at.
How long do you see how long the recovery might take, or back to what it was pre-pandemic? Or
so it's not going to get back to pre-pandemic anytime soon. And in speaking to landlords, first of all, there's been new office space coming on stream. The stuff that was started being built before the pandemic, and so we're still dealing with that overhang, especially in several cities like Toronto. But there's certainly no more projects being built. And so, growth will create increased demand and the vacancy rates will start to fall. So we think it's a pretty good time to be looking at this space.
And it sounds like for companies, this might be a moment for start looking for their own space within those.
Well, there's no question. We renewed our Toronto lease. First of all, we got our Toronto lease at the worst time, January of 2020, just before COVID.
Yeah.
But the renewal was January 2025. And office space was at a low in Toronto. So
I got to wrap it up there, but you got a deal. That's a good one. Always important. Lauren, thank you for joining us. We appreciate it. Have a great weekend.
Thank you so much.
Much thanks to Lauren Steinberg, the co-president at Lauren Steinberg Wealth Management. Thank you for joining us today. Andy Bell's up next with the Open. The market's open in 30 minutes. Have a great weekend.